So back in 2023, the financial world just stopped and stared. I mean, these multi-billion-dollar banks, pillars of the economy, they just, poof, vanished overnight. And this wasn't some slow, drawn-out thing. No, this was a collapse at like warp speed. So what we're going to do is really dig in and figure out the anatomy of a modern bank run. What makes them tick?
What we saw was it was something fundamentally new, simply because of how fast it all happened. We're talking about institutions that took decades to build, and they just imploded in less time than it takes to get through a weekend. This is not your grandfather's bank run with people lining up around the block. This is something else entirely.
And that right there brings us to the central mystery we're trying to solve here. Seriously, how is that even possible? What are the mechanics, both old and new, that can bring a financial giant to its knees, which is terrifying speed? To really get it, first we need to put some numbers on the board and see just how fast really is these days.
Okay, so take a look at this, because the story here is really told in the numbers. Let's go back to 1984, Continental Illinois. They lost about 30% of their funding, but it took 10 days. Now that's a crisis for sure, but it's a crisis that unfolds over a week and a half. Fast forward to 2008, Washington Mutual, 16 days. But now, look at 2023. This is where it gets insane. Silicon Valley Bank lost a quarter of its deposits in a single day, with another huge chunk, 62%, basically lined up ready to walk out the door. And Signature Bank, it saw 20% of its deposits just evaporate in a matter of hours. So this is the real problem, right? The clock speed of a financial panic has just accelerated beyond anything we've ever seen before.
So why is this speed so incredibly deadly? Well, to get that, we've got to peel back the curtain and look at the fundamental nature of banking itself. Because it turns out there's this inherent kind of unavoidable fragility that's just baked into the business model of every single bank. The whole magic trick of a bank, if you want to call it that, is this transformation. So think about it this way. Your money is tied up in something like a 30-year mortgage. That's a long-term, illiquid asset, right? You can't just spend it. But you need cash right now to go buy a coffee. The bank is the middleman that bridges that enormous gap. It's their job to turn those long-term investments into the on-demand cash you have in your checking account.
And this right here is the core dilemma. It's what economists Diamond and Dive Big famously pointed out. On one side of the ledger, you've got the bank's assets, things like 30-year mortgages, 10-year business loans. They're locked up, long-term. But on the other side, that's the bank's liabilities. And you know what that is? It's your money. And you expect to get it back instantly, whenever you ask for it. So the bank's entire business is just this constant, incredibly delicate balancing act between these two totally different timelines.
So how in the world do they pull off this balancing act? Well, first, they pool together deposits from a whole bunch of us. Then, they lend most of that cash out for those long-term productive investments we talked about. They only hang on to a small fraction of it as cash, just enough for what they expect people will withdraw on a normal day. And you know what? This whole system works beautifully, as long as we don't all show up asking for our money back at the exact same time. That is the razor's edge the entire system is built on.
And that what-if scenario, the one where everyone does ask for their money back at once, well, that's exactly what triggers a bank run. And the weird thing is, it's a phenomenon that isn't even necessarily about the bank being broke or insolvent. It's really all about fear, and how that fear can become a terrifying, self-fulfilling prophecy.
So think of it this way. There are basically two possible realities, or what the Diamond-Dybvig model calls equilibriums. In the good equilibrium, everything's great. We all believe the bank is fine, so we only pull out money when we actually need it for something, and the bank just keeps chugging along, stable as can be. But then there's the bad equilibrium. This is where we start to think the bank might fail. That little seed of fear causes everyone to rush for the exit at the same time, and that forces the bank to sell those long-term assets at a huge loss just to give everyone their cash. And by doing that, it actually causes the very failure we were all afraid of in the first place. And hey, this isn't some brand new idea. The foundational paper from 1983, the one that won a Nobel Prize for this very insight, spelled it out crystal clear. It's right there. The expectation of failure creates the failure. The panic itself is the weapon. It's what brings the bank down. It's this really powerful, almost paradoxical logic.
And this isn't just some abstract, theoretical idea. Diamond and Dybvig actually put a number on it. In their original paper, they calculated a very specific tipping point. They worked it out that if you, as a depositor, believe that more than 56.25% of the other depositors are going to run for the exit, then the single most rational, logical thing for you to do is to run too. Even if you know the bank is fundamentally sound, fear becomes strategy. It's game theory.
Okay, so we've got this timeless, fragile system. What happens when you pour the gasoline of modern technology all over it? The old-school problem of a bank run slams into the new problem of digital contagion. And the results? Well, they're explosive.
You see, today's financial system, it's not a bunch of separate islands. It is a deeply, deeply interconnected web. You've got banks, investment funds, insurance companies. They're all linked up because they often own the exact same assets. And that means a problem in one tiny corner of the system doesn't stay there. It can spread through all these hitting channels.
And the main way this panic spreads is through something called fire sale contagion. So imagine a panicked bank needs cash fast. It has to sell its assets, and it sells them at a huge discount, a fire sale. But here's the kicker. Other perfectly healthy banks own those exact same assets. So when the price gets hammered down, the value of the assets on their books drops for everyone. All of a sudden, those healthy banks look way weaker on paper, and that can trigger fear and panic about them, starting this whole vicious cycle all over again.
And this, right here, is where technology just completely changes the game. You know, back in '84, that continental Illinois crisis was called a lightning-fast electronic run, and that was just for big corporations using, clunky computer terminals. But what we just saw, that was totally different. It was a silent run for everyone. The withdrawals weren't happening in a bank lobby with people shouting. They were happening on a smartphone from anywhere in the world. And news wasn't spreading over days in the newspapers. Panic was spreading instantly on social media.
So regulators have basically boiled it down to three key things. Three new accelerants that can turn a tiny spark of fear into an absolute inferno. First, there's the tech itself. Digital banking means you can pull your money out immediately, 24/7. Second, social media. It doesn't just spread information and misinformation. It actually helps coordinate depositors at the speed of light. And third, something called depositor concentration. This is when a bank's customers all come from one single super-connected industry, like tech or crypto. They all talk to each other, they all hear the same rumors, and they can act like one giant entity, pulling their money out in a coordinated stampede.
So all of this, it forces us to ask a really fundamental question. We've seen the core, timeless fragility of banking, right? And we've seen these brand new digital accelerants. So, can those two things even coexist? Is our banking system, the way it's designed, actually built for this kind of speed?
You know, the main defense we built against old-fashioned bank runs was deposit insurance. It was a brilliant idea, designed to calm everyone's nerves and slow down a panic by just reassuring people that, hey, your money is safe up to a certain amount. But you have to remember, that system was created in an age of telegrams and evening news, not an age of tweets and instant transfers.
So that leaves us with the big question. In a world of instant information and digital withdrawals, is our banking system even capable of surviving its own fragility? That is the massive challenge that regulators and frankly all of us are facing right now.